Walk through many downtowns today and you will notice something strange. The buildings are still there. The glass towers still look expensive. The lobbies still shine. The names on the doors still sound powerful. But inside many of those buildings, something has changed. Fewer workers, more empty floors, less demand, more debt. And behind that quiet emptiness is one of the biggest financial problems nobody wants to talk about: commercial real estate. For years, office buildings were considered safe assets. Big companies needed space. Employees came to work 5 days a week. Landlords collected rent. Banks made loans. Investors trusted the numbers. Then remote work changed the equation. Not every office disappeared. Not every city collapsed. But the old assumption was broken. Companies started asking a simple question: why pay for so much space if employees are not there every day? That question changed the value of buildings, because commercial real estate is not valued like a normal house. It is valued based on income. If the building collects strong rent from reliable tenants, it is valuable. If tenants leave, shrink, or demand discounts, the value falls. Now add debt. Many office buildings were bought or refinanced when interest rates were much lower. Owners assumed they could borrow cheaply, rent space easily, and refinance when loans came due. But when rates rose, refinancing became expensive. A building that worked at a low interest rate may not work at a higher one. So owners face a painful math problem. The building brings in less rent. The loan costs more. The value of the property falls, and the bank still wants to be paid. That is the commercial real estate trap. The collapse does not happen all at once. It happens slowly. A lease expires. A tenant downsizes. A lender extends the loan instead of calling it a default. A property owner hopes rates will fall. A bank hopes the problem solves itself. An investor marks the value gently instead of brutally. Everyone tries to buy time, but time does not fix a building that no longer makes enough money. This is why commercial real estate can be dangerous for the financial system. The problem is not just empty offices. The problem is who financed them. Regional banks are especially exposed to commercial property loans. These banks are not always household names, but they are important. They lend to local businesses, property owners, developers, and communities. If enough commercial loans go bad, banks may pull back from lending. That affects small businesses. That affects construction. That affects jobs. That affects local tax revenue. Because a half-empty office tower is not just a landlord's problem, it can become a city problem. Cities depend on commercial real estate for property taxes. Downtown restaurants depend on office workers. Transit systems depend on commuters. Retail stores depend on foot traffic. When offices weaken, the pain spreads. The most dangerous part is the delay. Residential housing usually gets attention quickly because people feel it directly. But commercial real estate problems move through contracts, loans, extensions, appraisals, and bank balance sheets. It is slower, quieter, more technical, and that makes it easier to ignore. But ignoring it does not make it smaller. Think of a building bought for a huge price before the pandemic. The owner borrowed heavily. The tenants were expected to stay. Then remote work arrives, demand falls, interest rates rise. The building is now worth far less than the loan. What happens next? The owner can inject more money. The bank can restructure the debt. The property can be sold at a loss, or the owner can hand the keys back. That last option is more common in commercial real estate than people realize. If the building is worth less than the debt, some owners may decide the smartest move is to walk away. That sounds dramatic, but in finance, it is just math. The bigger question is who absorbs the loss. Sometimes it is a bank. Sometimes it is a bond investor. Sometimes it is a pension fund. Sometimes it is a private credit lender. Sometimes it is taxpayers indirectly through weaker local budgets and reduced services. This is why the commercial real estate crash matters, even if you never own a building. It can change the economy around you. Now, there is a counter-argument. Some commercial real estate is doing fine. Warehouses, logistics centers, data centers, and certain apartment buildings still have demand. Not every property type is collapsing. That is true. But office real estate is the weak point, and the office sector is large enough to matter. The future may not be a dramatic 2008-style explosion. It may be a long grind. lower valuations, more defaults, bank losses, empty buildings, city budget pressure, developers stuck, lenders becoming cautious. Sometimes the most painful crashes are not loud, they are slow. They drain confidence year after year. So what should viewers understand? The commercial real estate crisis is not only about buildings. It is about the old economy adjusting to a new way of working. It is about debt created under one set of assumptions being tested by a different reality. It is about banks pretending time will solve problems that math may not solve. And it is about cities trying to figure out what downtowns are supposed to be when offices are no longer full. The buildings still look powerful, but in finance, appearance is not the same as strength. A tower can look rich from the street while losing value behind the balance sheet. And that is why this crash is so dangerous. It is not hidden because it is small. It is hidden because too many powerful people would rather not talk about it. If this video helped you see the economy behind the empty office lights, subscribe to the channel for more clear and honest finance breakdowns. Thanks for watching.